If there's free money to get, go get your money. Get your match.
Whatever the match is.
All day long. Get the match, because this account, if you set it and forget it, you don't touch it, you don't pull any dollars out of it, you ensure that it is invested properly, it can grow to be your biggest account of all of them. So would you say, what would you say about that? Like, while you're young or you're like in debt, like, is this something you still do?
While you're young, because we have young adult children, and I have highly encouraged them to start saving in their 401k as soon as they're eligible. And start with whatever the match is. And sometimes, even if you're in debt, I would rather people be getting the free money at minimum and focus on the debt beyond the free money.
Welcome. This is For Better and Worth,
the podcast where we don't believe you have to sacrifice your relationship while you grow and build your net worth.
We are your hosts.
I'm Chris.
And I'm Erica Young, and we're so glad you're joining us today.
All right, y'all, let's get into it.
The For Better and Worth podcast is sponsored by American Heritage Credit Union, a not-for-profit credit union that helps you take control of your financial future.
As a member of American Heritage, you're an owner. You'll be charged fewer fees, earn more in the form of dividends on your accounts, and have access to lower rates on loans.
Whether your goal is to save for a down payment on a home, create an emergency fund, or build for the retirement you've always dreamed of, American Heritage has the products, resources, and solutions you need.
After all, American Heritage is for the people, not for profit. So to learn more, go to ahcu.co/for better and worth. Hey, babe, how you doing?
I'm good. How are you doing?
I'm doing good. I'm a little sore. Been hitting the gym hard and rode my bike this morning, so while it was necessary, I was like, it was a little harder this morning.
Listen, you know what? I think we cannot stress enough the importance of having a rest day. And so I'm looking forward to my rest day because I worked out this morning too, okay? Yeah. So, but I'm excited about what we're going to talk about today because I feel like that we assume we know these things or that people ought to know these things. And then we realize, wait a minute, we too have some room to work on this stuff.
And so I will admit I'm a little guilty of making that same assumption.
Yeah.
But today we're going to talk about, like, sometimes you got to get back to the basics and understand while you're saving, while you're getting out of debt, where you need to put your money and what accounts you should have and what you should be working through. Because I think some of these accounts, people underestimate the value of these accounts or even the necessity of some of these accounts. So
yeah, I think we need more accounts than we think we do.
Right. And
your money potentially is diversified because one way that you can be diversifying your money and where it is in, the accounts that you have. But
it's not even just all like retirement funds or retirement accounts. It's like, money has to move in different ways. And so you really should have a few different types of accounts set up that you're working through.
So I thought through some of the clients that I've worked with in my coaching work. And one family in particular had, between checking and savings, they had about 10 accounts just for checking and savings.
Wow.
Okay?
That's a lot.
Because the way that they wanted to use it is a savings for different purposes instead of one savings for multiple purposes.
Okay.
And then on the other extreme, I have worked with some people who have no savings accounts, but only checking accounts. And so what I realized...
That is interesting.
Yes. So, and here's the other thing. I can't tell you how it's countless people who believe if they have a credit card, they don't need a savings.
Oh, Jesus. Okay.
So,
Okay.
because people,
I gotta wipe my eyes. Like
I know, people like to use their credit card as an emergency fund, which we completely disagree with.
Yeah, don't do that, people, because it's too easy to get caught up with that.
It's reckless. It's reckless.
Yeah.
I like to say my savings account is my bank. Like the bank of me, the bank of us, the young bank. Like when we have a savings account, then we can go to our bank versus going to someone else's.
Credit card company. Well, I think we got to start at the foundation. So everybody naturally should have a checking account because money moves in and out of your checking account. If you're a W-2 or 1099 employee, or whatever you are, for people to get money to you, you need to have a checking account.
Yeah.
And that's usually going to be the clearinghouse where you pay all your bills, where your money flows into it from an income perspective. So that's number one. I think everybody can probably check that box. Oh yeah, I got a checking account. That should be simple.
So I'm gonna throw a monkey wrench into this. I agree with you. And I think what has made a checking account more complicated is the peer payment systems. So the Cash App, the Venmo, the Zelle. And I say this because
I got a butt coming.
I say this because people either hide money or they get reimbursed for something that they paid for peer-to-peer wise, and it's sitting in those accounts. And then all of a sudden, one day they're like, I got money over here and I can use it for this other purpose. And so it's sort of masking the full picture. But I do think that comes into play and it interrupts like checking being the full picture.
Yeah, I guess when you say the full picture, because even those peer-to-peer payment accounts require an account to be attached to them.
Yes.
So you have to have, even like Apple Pay, you either have to add money from an account or you have to attach an account to it, or, Cash App, Venmo, whatever, you have to attach an account to it. So you still have to have a checking account, even when you may utilize those peer-to-peer payments as an alternate source. And you can't hold cash on that. You can leave cash on those things and continue to pull from that. So I get what you mean by that, but I think even with that, fundamentally and just foundationally, you have to have a checking account that you operate from.
Yeah, absolutely. So,
what would you say? What's another one?
A simple savings account. Now, I understand that at most financial institutions, credit unions, banks, whatever, that...
And we like credit unions.
We do like credit unions. Shout out to our sponsor. But what I also think is that it's important for you to have a savings account close by, right? So have, even a smaller amount of money, but, just some money in a savings account for, emergencies so that you don't, again, have to use credit cards. So I think this is just protecting yourself from yourself, right? And so I know that most of these accounts, they pay less than 1% or a fraction of a percent. I get it. But this is cash and it's not meant to be, making money off of it, really.
Yeah. And, the way we like to operate, because we'll go to the next account, but we have a high yield savings and we have a savings at our credit union, because if something happens and you want to immediately access money, that local savings account is typically where you will go and do that. The high yield, it's instant, but maybe it takes
a couple days
sometimes to have that money transferred, depending upon how it's set up for yours. But typically most high yield savings will take, a couple of days to get access to those funds. So having something close to home that you can go and respond to an emergency or whatever is important. So, checking, savings, high yield. And we tend to put the bulk of our emergency fund in the high yield because we want to get the better interest from the high yield. And honestly, we want to kind of keep it at bay because you can't just be accessing that high yield for just whatever, because that's not what it's meant for.
So right now, interest rates on the high yield account, like rates of return on your money, is hovering around 4%. So 3.5, 4, maybe 4.3, depending on what financial institution you're with. And so that's always a good deal. Let's go get our money. Let's at least, like that helps you at least beat inflation or get close to beating inflation on your savings. And so I'm curious, since we do have two accounts that we consider our emergency fund, well, did I answer the question? Do you think that our savings plus our high yield savings is the total of our emergency fund, or do you feel like our high yield savings is the only emergency fund?
You already answered the question.
No. Just answer.
I think the combination of the two.
Okay.
I just choose to split where they're at.
Okay.
Because I want to have enough locally, so if an emergency happens, I can just respond in the moment. So typically, in my mind, I will set an amount that I shouldn't experience an emergency beyond this amount where it requires immediate attention.
So I know you well enough to know that you want is it at least 12 months of emergency fund?
Yes.
Okay. So at 12 months of our expenses to create the emergency fund between the two accounts. So typically we will tell people, so we're even more conservative, which a lot of people are like, okay, 3 to 6 months of expenses, whatever. I think because the other thing is we're like, I'm a business owner and like there's fluctuating income there.
Yeah, and I just like the security in it, you know, like.
But when we were in debt, we were not trying to have 12 months. We
were in the 3 to 6 month range because we were trying to put dollars towards eliminating debt. And now that we have moved from that phase, I just believe when you go from phase to phase, your strategy shifts, your strategy changes. And when you're in the debt elimination phase, it wouldn't make as much sense to me to have 12 months of expenses when you're trying to eliminate debt.
And we didn't have a fully funded emergency fund, 3 to 6 months of expenses specifically when we were in debt. We had something, but we didn't have, because here's the thing, let's just throw a number out there. If you have $10,000 in an emergency fund, but you have $10,000 in debt, and the emergency fund, let's just say it's making 4% interest, but the debt is costing you
20, 25%.
If it's credit cards, it doesn't make sense to keep that $10,000 in emergency fund when you can pay it off and save the interest that you're paying on the debt.
Since we're talking about that, I would take the approach like just keep $1,000 on hand, put the 9,000 on the debt. You got 1,000 left. You got 1,000 in emergency. Pay that 1,000 off, then start to build the 10K back up.
Exactly.
That's what I would say to do, just because then boom, you eliminate the debt. And you eliminate the stress that comes with the debt. And I think there's inherent value in removing that portion of it as well, because it's not just the debt, but it's the emotional stress, the physical stress on your body that can come with the worry that is associated with that. So So we say checking, we say savings, high yield savings, but we actually have another account that we utilize, and I think it has worked well for us. So.
Yes, so it's a non-monthly account. So for all of those things that are non-monthly, like they don't happen every single month. So for us, that is like our HOA. It is the auto registrations.
By all intents and purposes, it's another savings account.
Sure, it is another savings account. It can be a checking account, but we use it as a savings account. I don't know why you would need it as a checking account because
Yeah, I don't think you need it as a checking.
But our auto insurance, correct.
Our homeowner's insurance, our taxes.
Yes. So I have to pay quarterly taxes. We're putting dollars away.
Our property tax, we put in there. So
absolutely. So all of those things that don't happen January to December, they only happen one time or twice a year or what have you. We take the total amount of those annual costs to us and we divide it by 12 and then we fund that account on a monthly basis. And it can grow significant. If we didn't have to pay out the money, it can grow pretty significantly because between all of that stuff, we
could have put it in the high yield savings, but I think it just muddies the water
It does.
a little bit.
It does.
And people can say, well, you could put this money here, you could put that money in the market. Do what you want to do, okay? I'm going to just say that right now. So there's always somebody who has a different approach or a different philosophy, but we're going to give you what works for us.
Correct. And I think because we're more conservative in the way that we approach stuff, I do believe that it works for most people. So the one, what were you going to say?
You said we're conservative, and I was just laughing because immediately, to my mind comes the story of, the tortoise and the hare.
Oh, yeah.
How people say, you go fast, you'll go go further. Mm-hmm. And the tortoise was just, slow and steady. And I don't know, I saw a video or something, and they showed like it was a real life like tortoise or turtle.
Yes.
And the turtle was like off to the side on the sidewalk. Then it scurried and got to the
tortoise
water.
did?
Yes. It
oh
was
my gosh.
They were like, this not the tortoise that I heard about growing up because it took off.
That's wild.
It was gone and jumped in the water. And I just laughed because, people, look, we read the comments, but, we're not moved by the comments most of the time because it's not going to change what we do.
Good, bad, or indifferent, right?
Right. Good, good. I naturally like those.
Yes.
Bad or indifferent, I'm not moved by those.
but that's funny though, because I think we underestimate the tortoise. I feel like that's the thing is and let's be real honest. The tortoise is not sexy, okay? Like if the tortoise is going slower, like it's just kind of like moseying along, like okay. And then when you're not paying attention, the tortoise can go faster than you think.
I just, I don't know. I just had that visual when we were talking because, being quote unquote conservative can be like, oh, that's no fun. We're not making as much progress, but it's like, look, fundamentals work.
Yes.
And I know when I played sports, when I was younger, my coaches always talked about fundamentals. Mm-hmm. And even when I coached, our daughter and our girls in soccer, which I had never played soccer, but I learned fast. And I told them fundamentals win. Mm-hmm. And so when I think about people and fundamentals around money, it works. Mm-hmm. All you have to do is stay consistent with it.
Yeah, absolutely. So I feel like the non-monthly is that one tool that a lot of people don't consider and they're not really thinking, they might think it's not necessary but even just case in point, we, for Christmas, we set aside every single month 1/12 of what we're going to spend. Yeah. And so I feel like if we can add up all of the things that are not monthly, it makes it easier to pay them when they come up because our auto insurance, for instance, is like for the year, it's like over $2,000. And so I don't want that to come up 1 month and then have to pay that all at one time. I'd rather save $180 per month towards it so that when it comes up, I'm ready. It's way easier to budget that way than to not do that.
Look, I just talked about like the stress associated with, debt and just sometimes general money management can be a bit stressful. Mm-hmm. But I also think about practically how we have leveraged this non-monthly account.
Yeah.
And so when the bill comes and you see, the property tax is due or the auto insurance is due or the HOA is due, because for us, it's all due typically within a few months of each other.
Yes, December, January, February.
Right. And so when you get like one big bill, then another big bill, then another big bill, think about the stress that could cause for someone who has not taken the approach of utilizing a non-monthly account to save on a monthly basis.
Yes.
So if all those bills came and you just kept getting big bill after big bill after big bill, and then you got to go to your savings and you deplete your savings.
Or you use credit.
Right. And not then you're like, man, my savings is down. or my credit card bill is up, and then you got to figure out how to put the money back in savings or how to pay the credit card bill. This just alleviates all that. So we are going to highly encourage the utilization of a non-monthly account.
Yeah, so just review your overall budget and your spending and just see what are those things that are not monthly and see what it totals to and start putting it aside so that you know that you are always going to be prepared. The next account is likely your largest balance over time. And this is the one that you have to be intentional about. And I would say 20, 30 years ago, people were not near as serious about it because pension plans were what we could rely upon. But now that we can't 100% rely upon that, most of us, we need to go to a 401k or a 403b, whatever your retirement account is that's available to you at your place of employment. And so when we're looking at that account, my philosophy is real simple to start off with. If there's free money to get, go get your money. Get your match.
Whatever the match is.
All day long. Get the match because this account, if you set it and forget it, you don't touch it, you don't pull any dollars out of it, you ensure that it is invested properly, it can grow to be your biggest account of all of them. So would you say, what would you say about that? Like, while you're young or you're like in debt, like, is this something you still do?
Well, there's two questions there. While you're young, because we have young adult children, and I have highly encouraged them to start saving in their 401k as soon as they're eligible. And start with whatever the match is. And so, yes, I encourage that. And sometimes, even if you're in debt, I would rather people be getting the free money at minimum and focus on the debt beyond the free money.
As long as you can afford to do both.
Yes. Now, if you can't afford both, I mean, you may have to forego the free money for a period of time until you pay the debt down and put yourself in a position where you can get the free money. But I'm a big proponent to get the free money. And so we've talked about 5 different types of accounts so far. And I'm going to go into the 6th account because I think it ties into the 401k, and that is the Roth IRA. And if you work for a company that does not have a match, we're going to say start the Roth first.
Boom. I'm so glad you said that. Yes.
Start the Roth first, max out the Roth when you're able to do that after you've eliminated debt, then go to the 401k.
Because here's the deal. Here's the difference between these two accounts. The 401k or the employer-sponsored plan, the 401k or 403b, those are pre-tax dollars. So you get the tax benefit today, but when you take the money out,
you pay the taxes
the taxes then. On a Roth IRA, the benefit is this is after-tax investing, so it grows.
Pay the tax now.
Yes, and it grows tax-free. So when you take it out, you don't have to pay taxes. There are benefits to both.
Yes.
But typically we max out our employer-sponsored plans because we want the tax savings today. And you can put so much more in that account. Like the truth is that the opportunity to invest there, you can put
a lot more into the 401k than you can.
You can put $25,000 more, $20,000 more into that account than you can into the Roth. The Roth has limitations. It does both of those accounts, how much you can put in it. It increases every single year by $500 or $1,000. But whatever the case is, like, you know, the Roth will typically be a smaller account. And then if you have access to both, if you can do the match and also your income does not limit you or prevent you from doing the Roth, then do both. And then if you have more money to invest,
go back to the 401k.
Max out the 401k to whatever level you desire. So the coolest thing, I feel like this is just saying, is that you have options to spearhead or be intentional about your retirement future.
Look, and then if you work for an organization and it gets real sexy, you have a Roth 401k.
Yes.
It's like, come on.
Please do it.
Please do the Roth 401k.
Please do it.
If your employer offers that. So then you get the best of both worlds.
Yeah.
And at different phases, I talk about phases and strategy shifting at different phases of life. And once you start to get into, the phase that, we're in.
What is that phase, babe?
I mean, you get to that, closer to that, where you have to really start thinking about, like, being eligible to pull money out of these retirement vehicles.
Oh, you talking about you literally are talking about how close we are in age.
Yes.
Which is that 59 and a half age where you can pull these funds out without penalty.
Close to that, but what I'm saying is, like, your strategy changes because you can do, Roth fund conversions, from your traditional from your 401k or those traditional IRAs to Roth. So those are things down the line. But I don't want to get too far ahead of myself.
Yes.
My wheels are always turning, and I'm always thinking of what's next.
You, in another life, could have been a financial advisor.
Oh, man.
Or a stockbroker or some type of investment advisor. Like, I think you could have done that, or a plan manager. Like, you get off into that.
I told you, if I had a do-over, I probably would have got a finance degree, been a finance bro, and then try to be a hedge fund manager or something like.
Yeah.
Then I'd have had big pockets.
What do you think I could have been if I wasn't doing what I'm doing?
I mean, I think you could have did a bunch of stuff as well. I think you could have flourished in that same area because you have a very analytical mind and you're very process oriented, and those types of jobs require that sort of focus. I think you could have ran a fund manager.
Okay, not money related. Not money related.
Well, I mean, you could have been a professional dancer, like, because that's like your big passion. You will dance for free. You could have been Alvin Ailey dance troupe.
Come on now, yes.
That's the fun part, but my mind always go to the money side of stuff.
I know, and sometimes
it's wah, wah, wah.
I do this stuff for a living, and I think there's a part of me that gets tired of talking about it, but because you don't do it for a living, I think you get excited about talking about it.
I talk about all the other stuff that I do from a professional work side of things. So when I get on the podcast and we're talking money, I'm like, this is my hobbyist, enthusiast side coming through. So
I have one caveat about the 401k or any employer-sponsored plans, the Roth IRA that we already discussed, and then the next one, which is a traditional IRA, and then the one after that too. These 4 accounts where we're talking about investing retirement dollars, never be afraid to talk to somebody about how they're being invested. Never be afraid of that. So if you have an employer-sponsored plan and you have money in it, I really need you to understand how it's being invested. Like, what mutual funds do you have? Do you know what I mean? How is it performing?
Call the company that manages your plan.
Or
talk to them.
Go online and look for yourself to ensure. And so you should be able to have access to see how your money is doing. And that should not be only for the people who are managing the plans. So I just think, you probably look at it more than I do, but I'm pretty much a twice a year kind of gal on how often I'm looking at it. But when we do that, we are the ones that are in control of, do we need to make other decisions concerning our money so that it is in fact growing?
I want to see how my accounts perform.
Yeah.
But I think anybody who's listening to this right now, this is just a note, like, whether you're on top of it or you're new to it, this is a note to go and learn more about the 401ks, the 403bs, the Roth IRA, the traditional IRA.
Which is what? What is the traditional IRA?
Well, a traditional IRA is typically the fund where if you have worked for an organization and you had a 401k, when you leave that 401k, you can start a traditional IRA and it becomes a dump fund. That's what I like to call it. You take your 401k dollars from a previous employer, and then you take those and roll those over into a traditional IRA, and it continues to grow outside of like a 401k. So you could have a traditional IRA, a 401k, and a Roth IRA. And so I like to say the traditional IRA is just kind of a dump fund, because I worked for several corporate companies, and I leave one, I put it into my traditional IRA. I left another one, I took the money from my 401k and I dumped it into that, because I don't want to just let the money sit at a previous employer.
Here's why. Leaving it at a previous employer means that your access to a broad range of mutual funds or ETFs or whatever
is limited to what they provide.
Exactly. So typically these companies have like 18 to 20 different funds to choose from, which is fine in that space. It makes it easier for people to choose. However, there's 10,000 mutual funds or ETFs for people to choose from. So when you have a financial advisor outside of your employer, you can have more funds that potentially are doing better than what you have at work.
And the floodgates open when you start looking at directed investments, and you can get into real estate and all kinds of other things and use the funds from that traditional IRA to diversify your portfolio.
So you have more options for how you use the money and how you invest the money. And the other thing is why this is important too, just as a side note, is if your employer plan sucks, right? Like if they're not, if those mutual funds are not performing well, you have options outside of the company in order to invest for your future. Do not think Social Security is the only way that you can live in your retirement.
I got another reason.
Okay.
If you left a company, you left for a reason. And so do you want, maybe your confidence or faith in that company isn't the same as it was when you were employed there. So if you left and you're not relying on them for your financial, I don't want to say stability, but if you're not relying on them for your income, then why would you leave money there?
Yeah.
And not move that somewhere else where you can keep an eye on it and manage it. So it's another reason to just be aware, because I know people who have left companies and they get a letter or notification saying, oh yeah, you've got X number of dollars in your 401k fund with a previous company from 2 companies ago. And I like to know where all my money is at.
Right.
I like to keep an eye on it. So I don't want to forget, like, oh yeah, I had a 401k at such and such and I didn't move it. No, you better handle your business and stay on top of your money.
And you might move 5 or 6 times to different companies. And nowadays, young people are moving way more than this over the course of their time in the workforce. And so why would you want
4 or 5
different 401k plans at different places? Nobody wants that.
I'm going back to what I said. That's stressful.
It is.
Like, as soon as you said that, I was like, man, 4 or 5
No.
401ks, I'd be like, shoot, who do I call?
Yeah.
How do I manage it?
Exactly.
And no, I'm not trying to do that.
So this other account, I almost forgot about. The health savings account. You may or may not have access to this, right? This is all highly dependent on if you have a PPO or if you have a high deductible plan for your medical
insurance.
But if you have access to a health savings account, then this is an easy way for you to put money into it and leave it in there and only use it for retirement if you want to, or you can use it for health expenses right now, and it's all pre-tax dollars. So, I think it's, I feel like we're sort of in this quandary of how we want to use our account.
Yeah.
We have it, we have money in it. We're not necessarily allowing it to grow because we're still using it, but it can be a retirement tool if you leave the money in there until that time.
Because all you have to do is keep any medical receipt that you spend money on. And if you keep those receipts, you can go and take all those receipts at once and withdraw money from your HSA, because there's no time limitation on pulling funds out for medical expense. So just imagine if we chose not to utilize it, but we kept every single receipt that we paid money on.
Yeah.
And then do that for 5 years. In 5 years, we say, well, you know what? Maybe it's time to go and get all that money back,
Right.
you could go to the HSA, and if there's enough money there, you could take the money out of it. But that would be 5 years. You could also let the money work in the market and have gains because it is invested in the market. So it's another thing to consider from a strategy perspective.
The other part of that is part of the reason why you would want a health savings account is because things are going to get really expensive for your health as you age. And so in retirement, those are the most expensive health moments of your entire life. And having that as this backup plan that it's not necessarily retirement money, but it can be, but you can utilize it for health, coverages, the things that you need out of pocket at that time. And so it's a supplemental account for that. And so I think that in that regard, having it is nice. Again, there are limitations on how much you can put into it. So again, it won't grow as quickly as some of the other accounts, but it can still be invested in the market. And so I just think that that's a good thing to have in your back pocket, if you will.
There's a fundamental thing that we're forgetting about it too.
What?
The tax benefits.
Oh, for sure. Oh, no,
because the money you put into it now actually helps reduce your taxes. It operates almost like the 401k.
Exactly.
Because it's pre-tax, so it reduces your tax burden. Excuse me. It reduces your tax burden now, so you can bring that down when you put money in the HSA. So it has tax benefits in addition to longer term the benefits that it has there.
Yeah, absolutely.
So that was account number 8.
Yes,
that's a lot of accounts.
It's a lot. And we got one more. And frankly, I'm not going to say that we have all the accounts, but I am going to say that these are pretty typical. But this last one is one that we still need to get.
This is the one this is our last one to set up. But, But I think this is actually optional.
Sure. Yeah.
So us not having it isn't a deal breaker, but it's part of our strategy. That's why we're setting it up.
Yep.
But a brokerage account. And a brokerage account is another form of investment account that you can use to invest and grow into the market, and purchase other different financial tools. And you can pull monies from this account. So
it is not a retirement account. So it doesn't have any tax advantages. So this is just for you to be investing.
Just to get in the market.
Yeah, you can get in the market and you can be allowing your money to grow. It just doesn't have any tax advantages. Yep. But, for us, just as a peek window into our life, is that this is something that we'll likely use for a couple of different purposes, one of which could be acquiring real estate. And so just as a point of note, and it can also be used, for a vehicle purchase. I mean, it
can bridge the gap between retirement and Medicare. Mm-hmm. So, I mean, there's a number of different things that you can do. Maybe you decide you want to retire early, but you still need income, but you can't tap into your retirement resources. Mm-hmm. So you have a brokerage account that can help bridge the gap between when you actually want to stop working and when you can actually access your retirement funds. And so this is another vehicle to utilize because you can invest in the market. Maybe you want to invest in individual stocks, which, we're not big on that, but maybe you want to do that. You have here, you can pull the funds from here. There's a lot of options that you can do with a brokerage account.
Yeah, so it gives you some flexibility. And so that's our next step. But I just realized I forgot an account. It's the same as a Roth IRA. I'm sorry, it's the same as the 401k and the 403b.
As soon as you said it.
I have a SEP IRA, so self-employment plan. And so because I don't have an employer, I can put a portion of net income into that account. And so I do that on every year. And so that is another account that you can potentially have in order to make things work. And so I want to take advantage of all of the tax benefits of these accounts. And that's why we have a few of them.
And the SEP IRA falls up under the 401k, the 403b.
Yeah, it's the same
falls
kind
under
of account.
that category line.
Yeah, so. And it's dependent on, if you make more money, you can put more money into it. Yes. And so the good news for a business owner is that actually you can outpace how much you can put into a 401k with the SEP IRA as well. Mm-hmm. So just know that these things are available to you. And I think what I'm coming to realize is that this is sometimes why money can feel complicated for people, is because there are a lot of different places where your money can reside.
It's a lot to understand. It's a lot to understand. And I know when we first talked about doing this, I was like, well, man, don't people know this already? But as we're going through it, I'm like, there's complexities around navigating all these accounts and having these accounts and setting them up. And it makes me think about how our girls always, they come and they ask us questions as they are matriculating from, college to young adulthood, being on their own. And they see how adulting works.
Yeah.
And they see what is involved with really adulting and making decisions and all the decisions you have to make. And it's like, they're like, man, how do you know all this? Or how do you manage all this? And just thinking about, this is 9 accounts that we went through that all serve purposes in your financial life.
Yeah.
And so it does require some diligence when you look at all of these.
And I think the other thing is that hopefully, and I'm going to go to my make it worth it, because I think that this is the reason why us doing this episode is important, or my reason why it's important, is because as we're talking through these things, sometimes it gives you the thought of what you need to do for one of these accounts. Maybe now you need to set up a non-monthly account, or maybe you do need to go look at how your 401k is performing.
Yep.
Or maybe you're like us and you have other aspirations for some dreams and goals that you have, and you need to set up a brokerage account so that you can start funding that, right? Maybe those are some of the things that you need to begin to consider. And so my hope is that in walking through it, that it gave you some ideas on how you can improve your overall financial life, just knowing that these accounts are either available or you've put some things on the back burner that you probably need to bring up as a higher priority.
Yeah, it made me think about, maybe you're someone who works corporately and you receive deferred compensation, or you have supplemental investment accounts where you have to figure out how that's going to factor in. So there's a lot of things to think about. And I guess my make it worth it is, take time to sit down and figure out, 1, where you're at today. And 2, figure out where the gaps are, like what you need to fill in when we talk about these different types of accounts, from a checking to a savings to a high yield savings to a non-monthly account. Then your 401k, 403b, SEP. Then there's the Roth, traditional IRAs, HSAs, and finally the brokerage account. Figure out what you have and then figure out where the gaps are. And I think my make it worth it for that is, once you know where you're at, then you know where you need to go.
Yes.
And so don't get overwhelmed by, oh man, I need all these accounts. It's simple. Just take the time and, write it down, understand where you're at, and then you can chart the course on where you need to go.
Absolutely. I love it.
So
this is great. Yeah,
I think this was good. This was worth the time.
Yeah. So we have to hold ourselves accountable and get ourselves together on our own account.
Yep.
And I'm excited though, because it just means that we have put some action into our next steps.
Yes. So
I love it.
Keep pressing like, subscribe. We do look at those comments. And,
yes.
Keep following. And until next time,
we're out.
Thank you for spending some of your time with us today.
We appreciate all of your support. So be sure to subscribe, rate, and review us wherever you listen to this podcast.
You can find us on Instagram at For Better and Worth.
And sign up to receive our free guide, The 7 Reasons Your Money Relationship Isn't Working with Your Partner, on forbetterandworth.com.
Until next time, we're out of here.